We are in the market crash. And let's be real, with everything happening in the world, tariffs, global uncertainty, and yes, the ongoing drama with Trump, but here's the thing. I know it's tough to stay calm when it feels like everything's falling apart, but trust me, this is the time to take action. In this video, I'm going to walk you through 7 things you need to do right now to navigate this market crash, protect your money, and even position yourself to capitalize on opportunities. So whether you're new to investing or have been through a few crashes before, stick with me. We're going to break this down step by step, and I promise it's not as scary as it seems. Step 1, stay calm and don't panic sell. First and foremost, don't panic sell. When your portfolio is bleeding red, the instinct is to hit that sell button and cut your losses. But trust me, this is one of the biggest mistakes you can make. In fact, panic selling locks in your losses. The value of your investments is temporarily down, but unless you sell, you haven't actually lost any money. Markets are cyclical, and historically they always recover. A crash doesn't last forever. If you sell now, you might miss out on the rebound. Instead, stay patient. Stick to your long-term strategy. If you're investing for the future, this could be the best time to buy low, provided you have the cash and a solid game plan. Remember, markets have always bounced back after a crash. Step 2, review your financial goals and risk tolerance. Now it's a great time to review your financial goals. Take a step back and ask yourself, what am I investing for? Retirement, buying a home, paying for college? Understanding your goals helps you determine whether or not you need to adjust your risk tolerance in response to the market's volatility. If you're young and investing for the long term, you might feel comfortable riding out the waves. But if you're closer to retirement, this could be a good moment to reassess whether you're too exposed to risk in your portfolio. The key here is to make sure your investment strategies matches your goals, not just the current market conditions. Don't make the mistake of making drastic changes based on short-term emotions. Step 3, look for bargains, but be cautious. A market crash, much like a sale at your favorite store, can present some serious bargains, but here's the catch. Just because something is cheap doesn't mean it's a good deal. In a market crash, there are definitely bargains out there, but you need to make sure you're investing in companies and sectors that are fundamentally strong. Don't just buy because the price is low. Look for companies with solid balance sheets, strong earnings potential, and a track record of weathering economic downturns. If you believe in the long-term prospects of a company or industry, this could be the time to pick up shares at the best price. Step 4, diversify your portfolio. One of the smartest moves you can make in a market crash is to diversify your portfolio. If you're heavily investing in stocks, this might be the time to think about other asset classes. Things like bonds, real estate, commodities like gold, and my special one, my favorites, the Bitcoin. This is like the new digital gold. The goal here is to reduce your exposure to one particular market sector that might be heavily affected by the crash. Think of it like this. You don't want to put all your eggs in one basket. Your diversified portfolio can help balance out losses in one area with gains in another, smoothing out the bumps along the way. Step 5, build your emergency fund. If there's one thing a market crash should remind us all to do, it's to build your emergency fund. If you got cash on hand, it's like having a financial safety net. Experts recommend saving 3 to 6 months of living expenses, and this is the perfect time to get serious about it. Having an emergency fund means that if the worst case scenario happens, you're not forced to sell out investments at a loss just to recover unexpected expenses. If you've got some wiggle room in your budget, consider wrapping up those savings now while the market is down. Step 6, consider dollar cost averaging. Another strategy you might want to consider is dollar cost averaging. This is where you invest a fixed amount of money into the market regularly, whether the market is up or down. By doing this, you end up buying more shares when prices are low and and fewer when prices are high, which averages out the cost of your investments over time. During a crash, this strategy helps you avoid trying to time the market and reduces the emotional stress of jumping in and out. Consistency is key, and over time, dollar cost averaging can be an effective way to grow your wealth. Finally, let's talk about the psychological aspect of a market crash. It's easy to get caught up in the panic, the constant headlines, the social media posts, the doom and gloom everywhere. It's enough to make anyone feel anxious. But remember, this is a marathon, not a sprint. Taking care of your mental health during these times is just as important as taking care of your money. Avoid making impulsive decisions based on fear. And remember, the market is not the only thing that needs your attention. Spend time with your loved ones, get some exercise, and take a deep breath. You've got this. So there you have it. 7 things you need to do during a market crash. It's not easy, but with the right strategy, patience, and mindset, you can not only survive a crash, you can thrive. If you found this video helpful, make sure to like, comment, and subscribe. What are you doing to protect your money during this market crash? Let me know in the comments below. And as always, stay calm, stay informed, and keep investing. I'll see you in the next one.